Hey guys, we are back with Kevin Green. This is the Commodity Report, and it's a lot to talk about in the commodity space this week. Just started out, let's go over basically the performance over this last month. And this month's month to date performance, orange juice is the leader. I know everybody trades orange juice, it's everybody's favorite product. So, one of the least traded products on earth, but at the same time, orange juice does have a lot of alpha. People don't trade it, but the thing trends, and the reason why it trends, and a lot of these smaller commodities trend, is there's just not much in the way of news flow. When you have a lot of people pushing the price makes very large jumps very quickly. Futures also offers leverage. What I kind of find funny is everybody's so obsessed with leverage through options. They go, options are great. Options give me so much leverage. And it's like, do you have any idea what futures do? And then it also gets rid of time decay. So, getting into the futures market will be a lot better than and also it ups your win rate. You'll talk to people and they'll be like, yeah, to be if you're just buying options and if your win rate's around 20%, you can make money that way. But at the same time, if you trade futures and you have that same leverage, and you don't have to deal with the time decay, your win rate can go up. Once again, you still have to trade small, like risk management is always the most important thing, and position sizing. At the same time, futures also offers a lot of leverage and a lot of products that you can't trade in the normal stock market. Right behind that, silver, 20% month to date. What a move. Silver broke that $30 level. Kevin and I both kind of have the same thought. It's going to probably pause around this level, but it did break that level, which is pretty significant. We haven't seen that in silver for a while. This is kind of saying that the precious metal market still has more room to run. Once again, consolidating here doesn't mean I'm saying, it's going to move back into a downtrend. I'm just saying it wouldn't be a bad idea to consolidate here. This has been a huge move, 20% month to date. Natural gas up almost 20%, over 18% month to date. Wheat right behind that, 15% month to date. Platinum right behind that, 10% month to date. Canola right behind that, 8%. You realize I haven't named any of the indices at the moment. So it's beating out all the indices on these top commodities at the moment. That's quite interesting. Coffee, and over the last week, let's see what the winners were. Over last week, cocoa. That's something you and I could talk about a little bit more. Cocoa on the catch-up trade, man. That thing came down. It was like, it's over. I mean, including myself. Like, I'm not one to be like, when commodities make huge runs like that and they give some back, usually it doesn't head right back up to the upside. Now cocoa's up 23% in just this week. That's pretty amazing. Oats right behind it at 5%. Coffee right behind that at 4%. Orange juice right behind that at 3%. Cotton at 2.5%, and silver right behind that. Oil started to pick up a little bit yesterday, up 2% for the week. Kevin, you seeing anything significant in any of the markets I named, or in the commodities market in general?
Well, yeah, I think the energy market. Let's start with energy, right? So I think the energy market's still trying to kind of digest the macroeconomic data. What is OPEC going to do as well? I think we caught a little bit of a bid the other day because of there's a whisper in the market right now that OPEC's going to extend its production cuts, right? We haven't had that confirmed yet, but if that's going to be the case, it's a little bit of a bull case for a move to the upside. I don't think it's going to be much though, but a little bit, right? And then you kind of have on the flip side of that, you have Saudi Arabia potentially, once again, one of those rumor mills that they're going to be cutting prices for the Asia countries out there, which is actually a bearish formation. So we're still kind of churning right now. And if you're a bull, you want to see a churn and not a continued breakdown in crude, right? And that's something that we have seen. And I'm a little bit concerned about it, but I believe the EIA data that we're going to get this week, tomorrow actually, because we have the holiday, probably will show another build in inventory and maybe some more bearish formations when it comes to some of the byproducts that are out there. I think the key item to look at is going to be the gasoline demand number, right? Like that's the area where the market is fading and is a little bit more concerned, but it truly hasn't shown up yet fully within the industry data yet. Meaning, are we seeing peak consumption going into the driving season, right? We just kicked it off with Memorial Day. We should start seeing consumption actually continuing to rise to the upside here. But if you're looking at the year-over-year comps of what we just saw for last week, we actually are down incrementally, but down incrementally on a year-over-year basis, which is not a really good sign to be able to kick off the year. We also have refining rates that have finally now broke the 90% level, which is not outside of the ordinary, especially in the summer months. But you want to see that refining rate kick up, and you also want to see supplies also leveling out. That's going to give you that equation. I think we talked about that last week, right? Whatever that you refine, whatever is then consumed minus that, and then you have your inventory, right? You either have your surplus or your shortage. So you want to be able to see refining rates and inputs actually continuing to rise. And if that is going to be the case, you want to see consumption rising as well. Basically right sizing the energy complex as a whole. Gasoline is actually seeing a little bit more of a, let's call it more of a beta right now, right? A little bit more volatility than what we are seeing for crude oil. That is something that we have not seen over the last couple of months, and now you are seeing it. And unfortunately, that movement or that deterioration is to the downside, and you're actually seeing that today in gasoline as it's down about 2% in the session. Oil's down about, let's say 0.95% right now, let's say 1%. It was up a little bit higher earlier in the session. And now we have heating oil, which was actually holding up to start the day, starting to fade out here a little bit. So the energy patch, still a little bit concerned with the heating oil and diesel being below that 200-week moving average. For oil, we came in within, give or take, we came in last week, 50 cents from that 200-week moving average, and caught a bid back to the upside. That's the action you want to see if you are a bull in this market. But we do have a breakdown from that primary channel that is a little bit concerning. And then for gasoline, we're about, let's say, 10 cents, 8 cents, 0.08. So 8 cents away from hitting that 200-week moving average. You don't want to see gasoline hitting that as well. That all being said, right, the China data is looking great. We had the IMF actually upgrading their target for GDP because of some of the data that we are seeing out of China. We do have a real estate issue that's out there, but from an industrial standpoint, we're starting to see something hold there. So I think that would be the bullish case. And that's kind of where we're at in the energy complex, man. We kind of talked about, I brought up this ratio, or not a ratio chart, this crack spread chart that somebody wanted to see earlier and get a link to. We're sitting at around $24, right? That's kind of like the lower end of that range. So you want to see something move. And the only way that you can expand a crack spread, for those that don't understand, right? So a crack spread is taking like 3 barrels of oil and then churning out 2 barrels of gasoline and 1 barrel of diesel. There's, I don't want to say hundreds, right? But there's probably like 15 to 20 different spreads that you can develop across the world in order to try to figure out what the break-even points or what the profitability points are for a lot of these companies, not only here in the United States, but around the world, right? The only way that you can expand a crack spread is that the price of your input, which is going to be crude oil, goes down and you have your byproducts remaining at the same level, or if your byproducts move faster than the rate of change for oil, right? So you have cheap oil, you have higher prices for byproducts. That's how you get crack spreads to move to the upside. Right now, they have been in contraction, and we've seen that across the board from the energy complex here. But I don't think if you're talking about it from an earnings power standpoint for energy companies, where it is at right now, could it have a material impact on profitability? Maybe, but I don't think it's at the point where people are freaking out by any stretch of the imagination. And so that's kind of where we're at. I'm indifferent when it comes to the energy complex. 80 to 85 is still kind of like my thing right now. But bringing that down to say a 77.5 is not out of the realm of possibility for what I'm looking at in the near future. We just don't have enough data. I need like 3 more weeks of data to see if we are at peak gasoline consumption, along with us getting 3 weeks into the actual driving season. That divergence in trend, that's divergence in seasonality trend, would be that telltale sign that we might be seeing some gluts here in the next couple of months. What do you think?
I'm on mute. There we go. But no, I like that. I like the idea of, once again, it's like, we're here to, and this is a thing that I think a lot of people don't grasp in our field, which is we're not here to report on where we think oil should be. We're here to report on where oil is, where it could be profitable, and what our probabilities are of moving higher or lower. That's it. We don't know the future. Because we don't know the future, the best thing you do as a trader, and nobody does, people expect people like us to be able to tell them, well, where do you think, you random coffee conversations for Kevin and I going hanging out with some friends who hear what we do. They'll be like, well, where do you think Apple will be in 2 years? Or Tesla, you hear this stuff all the time. And really our goal as traders isn't to know exactly where something will end up. Our goal is to put the probabilities on our side, think about what the future might look like, and figure out how to put that together. Now, that could be fundamentally, it could be technically, it could be using systems. However you do it, we're all kind of doing the same exact thing, just in different ways. There's many different ways to trade. But if we look at oil, I was just looking at all the charts. It really looks kind of across the board, very similar setups besides oil itself. Oil itself has this, kind of fake out pattern like you talked about. It came all the way down, got to that 200, almost close to that 200, and then faked back up. It had a false breakdown, basically. We got under that $76 or that 76 level, 76.75, let's say, came all the way down to just about 76. That's front month contract, and then we bounced. Most of the time when we see a bounce like that, that is very constructive of a move higher. But what I'm not seeing, and what Kevin also brought up, is where's the rest of them? If we look at gasoline didn't do the same thing. Gasoline tried to carve out a little bit of a bottom. It didn't follow it at all. Heating oil, while it was up a little bit today, it is trying to carve out a bottom a bit. It did make a higher low around that same area where we saw that false breakdown. But can we get above that level of 250, 251? If we get above that level of 251 or get a close above 250, like a nice strong close above 250, then I would be a little bit more interested. I'd say, hey, maybe this has some more upside to move. But in the short term, even, I'm really not seeing it yet. Like Kevin's alluded to this whole time, the being under that major, 200 week is a major trend area. That when you're looking for major trends, and we're talking words like primary trends, what that means is it's not about the tradability of something at that point. It's about, is the primary trend moving up or down? And you can do this in a bunch of different ways. You can set up a primary trend in 52-week highs. Like let's say you're looking at a chart, you're marking out 52-week highs. A bunch of different ways to do this depending on your software. If you have stock charts, it's called price channels. You use 52-week highs, just put 52-week into, or 52 into a weekly chart, and you can see that making 52-week highs or 52-week lows. And in TradingView and TrendSpider, it's called a Donchian channel. Most software is called a Donchian channel. And so as a Donchian channel, you're seeing that that's the same thing. Set it up at a 52, put it on a weekly chart. You can see weekly highs or lows. And same when Kevin talks about the 200-week moving average, it's another way of doing it. Everybody just has their own preference on that. Either way, on both of these indicators, we're seeing heating oil continue to make 52-week lows, even though fundamentally Kevin and I both see that there's possibility of some upside here. So does it keep bucking this pattern? And that's kind of what we have to keep an eye out here. Will it keep bucking this? There's a bullish backdrop for oil, heating oil, gasoline, energy really at the moment. Does it keep bucking the seasonal pattern? Does it keep bucking this trend that should be happening here? And if it is, that's telling us something. The one thing that I'd also keep in mind is bonds. Bonds being, the thing you always have to pay attention to. So bonds, even though we have oil, oil had this nice little move higher, sure, and it gave some back today. Bonds have not gone the other direction. They continue to move down. And most of the time, these two things are inverse, meaning oil moves up, bond prices move down. Or, if you're talking yields, because there's two different sides of each bond, there's yields moving up with oil. And so now yields are moving up with oil. We're seeing that, as these bond yields keep moving up, bond prices keep getting hammered. That's also telling us something about the inflationary picture and the inflationary backdrop. So, we have to keep an eye on oil here. I think if oil starts to clear some of the levels that we're talking about, getting up and over that 200-week moving average on heating oil, getting up and over the levels that Kevin's talking about. Kevin's saying that oil should be, between that 80 to 85, right, Kevin?
Yeah, 80 to 85 has been kind of the range that I've been looking at for the last 5 months, 6 months now.
Yeah, so getting back above that level of 80 to 85 on oil, getting up above that 200-week moving average on heating oil, and then gasoline, starting to show some actual relative outperformance to oil. Those are three things that I'd be looking for here right now, to kind of get a little more bullish on the sector. And then if we look at the sector itself, so if we look at energy, energy on 1 day performance, it's last today. So that's not looking too great for energy. But on 1 week performance, it's in fourth place, down 2.5%. For the move in the market, that's not that bad. But once again, it's still down 2.5% in a 1 week in 1 week performance. And 1 month performance, it's down almost 5%. In 3 month performance, it's up 6.5%. So it's not out of the race just yet. What I like to take, if I'm looking at relative strength on different timelines, the one that back tests the best is a 3-month time frame. So if I'm looking at it on a 3-month time frame, I'm still saying there's a possibility of this still moving up here. However, there's reasons that Kevin and I are both seeing to be a little bit cautious, and at the same time, there's things we just gave you kind of a template of a few things to take a look at and watch for: the 200-week moving average on heating oil, the oil getting back up and closing into that $80 level, and then gasoline starting to show some strength. And so if you see those three things, the energy sector might pick up.
For sure. Yeah. And just to kind of note too, all right, so here's how, let me just put the backdrop here. Can I go on a real quick rant?
Oh, please. Please.
All right. So here's the backdrop here for the energy complex to kind of be mindful of. This is going to be more longer term, right? Looking at the remainder of this year, and just hear me out on every single area of this, because it'll start to make sense here in a second. All right, so let's say we do have a breakdown in crude oil, a significant one. Right now, if you actually look at the chart, we're still in a technical uptrend for oil. If you're looking at a weekly chart, but we're getting pretty close to being able to break that down. Heating oil kind of just resumed its official downtrend from the peaks that we saw 2 years ago, 2.5 years ago, right? 2 years ago. All right, so if you're an energy company, we kind of talked about those crack spreads, 3, 2, 1. You're trying to make profitability on the products, right? Refining crude, refining whatever energy type of product, if it is Brent, if it's anything else that's very unique, heavy, sour crude, what have you, right? You want to refine these and you'll be able to sell those out and make a profit for them. And usually when we start seeing markets bottoming or certain products that are just not as profitable, refiners will then change their mix and then focus on products that are profitable, right? Really simple concept. And so if you're looking at it from a summer seasonal type of standpoint here, gasoline should be front and center as far as demand side. Doesn't mean price side, but it means demand side. So what could we see? We could see refiners saying, okay, well, diesel and heating oil or whatever, fuel oil, we're starting to see that slide here a little bit. But there's opportunities in the gasoline side. Even if we do see peaking out and we just maintain levels, they will supply that market as much as they possibly can until it becomes unprofitable, right? And so that will actually take away from products like diesel. And this is exactly what happened in October and November of last year. Actually, August, September of last year, really, when we had that peak out, right? And everything moved to the upside and everybody wanted to be in the energy. That's when we started seeing diesel and heating oil fade. And we saw it fade not only because of the seasonality of heating oil and diesel, right? We typically see these situations where actually in the winter months, they can catch a little bit more of a bid, or they have a little bit more upside volatility skew to them than say crude oil or gasoline. So if we are seeing this kind of like glut situation that's kind of taking place, because we are seeing a buildup when it comes to distillates. We have refiners starting to focus on gasoline, and maybe they supply gasoline, maybe they even oversupply, but then they neglect the diesel side or the heating oil side of the equation, if you will, right? Once you get to that seasonal, October-ish, when I start talking about heating oil, I get to September. September is when you want to start setting up. If you're making seasonal trades, you want to set them up 2 months, 1 month, 2 months in advance before the actual season kicks in, because everybody else then is having this FOMO once it really kicks in. You want to kick it in when you're talking about heating oil and diesel in the winter months here. We could have a scenario where because supplies are ample right now, we have an adjustment to the refining mix, and basically heating oil and diesel and then gets neglected. We could also have prices kind of like make a little bit of a lull here in the summer months. And then in the back half of this year, once again, October, November, December, once you start getting into those colder months and people start putting on those seasonal trades, maybe that's when we start seeing diesel kind of catching a bid there. There's a macroeconomic factor that, once again, it's a curveball. We don't know where we're at right now because we just don't have enough data. But if we are seeing a little bit of a peaking out of the consumer itself, like we saw in the Beige Book commentary today, consumer discretionary starting to pretty much flatten out, maybe small incremental pockets in certain geographic regions that still see the consumer as being very strong and robust for consumer discretionary goods, which is going to feed off the transportation sector, right? Which is going to then need fuel to be able to ship those products. That could be in a cycle. That could be the cycle that we are in right now. We just kind of like don't know. I just would say holding pattern right now. If I'm looking at the crude chart, here's the thing that is a bright spot. Bright spot is we are seeing RSI for the most part starting to level out. CCI for the most part in a trying to do a bullish divergence here. We have stochastics already crossing. I'm looking at the weekly chart here. Unfortunately, we have the MACD crossing though in a bear cross. 12 is below the 26. And if you guys notice, I'll talk about weekly charts a lot. And that's usually where I get the primary trends that you were just kind of talking about, right, Jason? And if you put some of these indicators that we know and love, RSI, which measures kind of like the price, change in price over a relative period of time, right? Most people use 14-day period average. So if your price is continuing to expand or move at a rapid pace to the upside or downside, you have the RSI kind of moving to the upside when its price advances continue to increase on a day-by-day basis, and then RSI moves to the downside when they decrease at a rapid clip as well. You have the same type of thing, and that's the same type of calculation when you're looking at CCI. So I kind of interchange those, but they are two different. CCI is looking at the relative price change compared to an average, that 14-day moving average, rather than the 14-day relative price, right? So that's just something to kind of keep in mind. For crude, once again, kind of seeing that like that MACD cross to the downside is concerning to me. But if we can bounce off these moving averages, I think that would be a good sign, to say the least here. It does appear that the stochastics, when you're looking at the short-term moving average, is kind of trying to hinge up. And when we see those hinges on the weekly charts, they're a little bit more dependable for you to kind of get ahead of those trades, even though a lot of technicians will say you wait until the lines actually cross when you have the short-term crossing above the long-term moving average for stochastics. But when you're looking at weekly charts, you have to have a little bit of give and take, because it can take weeks for that cross to actually occur, and you can miss out on $4, $5, $6 worth of move. You usually don't see fake outs so much on those longer term indicators when it comes to the energy complex. Anything on that, and then we can kind of talk about grains, because I did have some information on that one too.
No, that's perfect. And I like what you said about the stochastics. When you back test it, that's very true. I also just take the shorter term moving average rate off of it. So that's something that I think is very important. Just take the short-term moving average off of it, because so many people get stuck in waiting for it, and it's like that is not how that works. Like even on the shortest term time frames, you don't want to do that. So great addition. I hope people also caught that. Secondly, you mentioned CCI. Every time I've told anybody that I use a CCI, they ask me how old I am. So I think that's funny. I just wanted to bring that up because I do use the CCI as well, but it's like it's one of the older indicators. Like a lot of people use RSI these days. CCI actually found more of an edge, which is the reason why I use it. So I thought that was cool that you brought that up. I wanted to actually pull up the seasonality chart. And we built, we actually have a system. I'm actually not allowed to share it at the moment. At some point, maybe I'll be able to do that again. But I wanted to also talk about, what Kevin said with seasonality. And so when we're looking at seasonality and we're looking at one seasonality like this, when we're looking at blocks, it's very hard to tell the exact jumps, when to get in and out. And also we're looking straight over a 40 year period. So straight over a 40-year period, this is not the way to find the most efficient short-term trades. However, in the short term, and looking at what Kevin said, is getting in a little bit before the move. Now, if you're a seasonal trader, I really feel like in any good seasonal trader will say they have two different ways of doing things. One of those ways is looking at the seasonals, and you could just buy, like, let's say the best 6-month period. So the best 6 months in the U.S. stock market is from November till April. And if you just look at that period, it has the best months, good seasonality. However, if you just buy that blindly, it doesn't really work out that well. So most of them have some sort of trigger that they'll use. So I have found for me, sometimes when you're seeing, like, let's say right now it's May. And before May even ends, let's say we start to see this very strong oil market. Somehow, in the next couple days and into the first week of June, we start to see a lot of strength. Sometimes that's telling you something when you're using seasonals. That's the almost relative performance, relative strength, however you want to put it, and showing you that maybe it's bucking the seasonal trend. That could be a very good sign that we're seeing. But once again, we're seeing that it's kind of following the normal seasonal pattern. We're topping out in April, coming to May, we start to see it move possibly back up here at the end of the month and into next month, and have a strong July, which is historically one of its best months. So getting into that summer season that we've talked about, have this very strong July, maybe a strong move getting back up to, I'm not calling for $100 oil like everybody on TV is. I'm just saying a nice move. And maybe we see some strength into this kind of into these middle of the summer months. So, I just kind of wanted to go over that because we could see some strength getting into July here, and just the summer generally. I really try to not take seasonals too literally. I try to think about it like the summer has a very strong period in the middle of the summer. That can be the end of June. That could be the middle of July, but take buy signals around those times. That's a smart thing to do and a good way to look at seasonals, because seasonals aren't a trading tool in itself. It's just a good why am I losing the word? A good filter to use for your trading systems.
Yeah. And that's a really good point too. So kind of like, if you're trading on the seasonal, well, one, you need to know those markets, right? And then two, just understand like for the commodities, most of that seasonal is a weather component to it, where weather is like playing craps at the casino, right? You don't know what you're gonna get, but if you play long enough, you'll see somebody hit, sevens or whatever, right?
Yeah.
If you hit long enough, and if you have yourself a time frame to be able to let that weather pattern type of situation work out, then it can be a very beneficial quick trade. But then you gotta bounce out of that, like, because it's not going to be, when you're trading on weather, it's not going to sustain. So you are definitely right there. Let me transition over to a couple of other things here. All right, I'm going to do kind of like a rapid fire thing. So I want to get your thoughts.
Yeah, go ahead. Let's do it.
All right, so for copper, look, copper can maybe be able to continue to run here. We saw that pullback last week. What was it, like, 5.5%, almost 6% pullback? Might have been 6%. I don't know. I was out, but it was a nice little pullback here. Now, from a technical standpoint, you sell off, you try to regroup, and then you try to move higher. I'm saying I think support is sitting at 450 for copper. So even if we had a little bit of a sell-off this week going down to 450, maybe we do see the market kind of consolidate and then try to push higher. I think that would be the case. be mindful. We're going to get some smelting data from China here, and I believe this week or next week. Smelting data is basically the smelting operations is like refining copper ore or refining copper in some way, shape, or form. Just note, China has been getting scrap copper and trying to utilize recycled copper in order to meet their needs and trying to get away from copper ore. And it seems to be working. It seems to be working. I'm not sure how long-term sustainable that's going to be, but they have been able to find a way to alleviate some of the pressures that they're seeing in the copper market. So we got to keep that in mind there. The trend is still bullish, but you are seeing a bearish divergence on the CCI. You are seeing RSI. Now it has backed off a little bit there, but it was overextended. I would expect that to go to the downside here. And then MACD is still in a bullish formation, but we are still starting to see the 12 period moving average starting to hinge there. Once those signals align and cross, I would say look out below because the copper trades very, very strongly to not only technicals, but to that MACD signal on the weekly charts. So I wanted to go with that one. Dollar seems like it wants to move back to the upside here, but we have like this, consolidating type of wedge that we're not there at the apex yet, but in another couple of weeks we are, where either we're going to break to the upside or we're going to break to the downside there. A lot of these commodities has not respected the dollar move whatsoever. Could care less what the dollar is doing. But if we start getting into more of a normalized market and the dollar does start to strengthen a little bit, that could be bearish for a lot of these commodities that we've been talking about, especially when you're looking at the grains, because the dollar was fading. Export demand for near-term crop was actually increasing, or old crop, if you will, was actually increasing. So I'm keeping my eye out for the dollar this week. That being said, and I know I'm all over the place, that being said, Friday's a huge day, PCE. Market is expecting, it's not a hot print. They're not expecting a hot print, but there's a whisper number of 0.3% month over month for headline PCE. I'm going to go more with what the Fed is talking about, the Cleveland Fed, and I do believe it'll come in at 0.21%, lower than the street's expectations. That would be bullish for equities. That would also be potentially bearish for the dollar in a sense, if the market then thinks that the Fed may back off of some of this hawkish commentary that we've seen over the last couple of trading sessions there. So that's going to be that for the dollar. And then I have three more. Soybeans, nice run. Be careful. We've had some industry data that has come out here that's very, very important. One, we had the situation that was going on in Brazil and the floods that were taking place, right? Those floods, the amount of precipitation that they're receiving right now has subsided, right? So they're starting to recover. Initially, there was a fear that we would have maybe 4 to 5 million tons of grain being impacted. The majority of that would be soybeans. Now the market is projecting 2 to 2.5 million tons. So that's lower than what the initial expectations were, which is ultimately going to be bearish, right, for soybeans. We do not know the full extent of what the harvest is going to be right now, though. And we do not know the extent of what has happened to the silos that were submerged. Because if the silos were submerged for a very long time, it could ruin the crop as well. So we're not only talking about planted acreage damage, but we're also talking about stored reserves in the grain complex as a whole. Soybeans, nice run. Keep that in mind. The other reason why I'm a little bit concerned about soybeans, though, Jason, is we've had some kind of mixed weather here in the Midwest and kind of an issue of trying to get corn into the ground. And if we don't get corn into the ground in the next 2 weeks, you kind of have a problem. And a lot of farmers are going to have to switch from corn over to soybeans because soybeans you can plant as a late crop. And if that's going to be the case, then soybean inventories or soybean end of year stocks could be higher than what the USDA projected. While on the other side of that, corn inventory could actually come in lower than what is expected. So based on what we have right now, we're expecting 2 great weeks of weather. So this could actually change everything. But if we don't see corn getting into the ground, we could have a problem when it comes to corn. We could have a problem to the upside when it comes to corn price advancing. Downside when you look at soybeans because domestic production would be over the USDA's expectations. And then the wheat market, Still seeing some positive trends there, but also be kind of mindful. That was a Black Sea type of an event when it comes to weather. Seems like that might be subsiding here a little bit. And that could also give way to the wheat trade. And the wheat trade is based on weather right now. We had the initial offsides positioning that has been, for the most part, worked out. We had a situation where geopolitical, obviously, that has not been worked out, but that's been factored in. And now we had the weather events that were happening not only in Russia, but also in the Ukraine, and even here in the United States in some respects. 2 of the 3 of those from the weather standpoint have started to subside as well. Out of all of those, wheat's probably still the most bullish out of all of them. But I would say that's kind of my outlook when it comes to grains. Soybeans pulling back most likely. Corn maybe stalling out, maybe pulling back a little bit, but has a little bit more durability and price action. And then wheat, out of all of them, probably could hold up here. Wheat is hitting a major moving average though, and that is the one that I'm keeping my eye out. That 200-week moving average, once again, we talk about it all the time. That one's being hit. And if you're looking at corn, I am a little concerned about corn because it's hitting the 100-week moving average, and it's faded that literally since 2022. So you got to break above that. And then for soybeans, we have that at soybeans is trying to approach the 100-week moving average, but it could utilize the 20-week moving average as an area of support. So the grain trade has been great. I'm just saying, kind of like, be cautious. We're supposed to get a lot of grain reports on Monday, this Monday coming up. So that'll probably be the deciding factor to the upside or downside for a lot of these markets. We'll probably have a resolution by then.
No, great stuff, Kevin, and really good rapid fire. Just kind of going through all of these. There's only two of them. If you got a second before you have to go.
Yeah.
Okay.
No.
So two of these that I wanted to talk about. One is coffee. We've talked about coffee before, having kind of a similar setup to most of the South American products that we've been seeing lately. And I've been pretty bullish on coffee. You've heard me talk about it a million times. What are you thinking about coffee here? Do you think it has more upside? What do you fundamentally, not talking about the charts, obviously it's in an uptrend. That's why we like it. I'm a simple guy. Kevin's the smart one of the bunch. What are you thinking, Kevin?
Look, from an industry standpoint, there is a little bit of concern about supply out there. And so that's kind of given a little bit of price advance, or giving some reason for the price advances. We also have recency bias when it comes to soft products right now, which could also create aggressive buying, even though people may not even know exactly what's going on with the crop in general, because we just saw cocoa just like rip every short's face off, and they probably are out of business at this point in time, right? I don't think coffee is going to be as dynamic as that, but the weather events of having too much rain is a little bit of an issue right now when it comes to the crops. I wouldn't fade it. I wouldn't fade it right now, and you probably have a sustainable month or 2 months of power there until we kind of get into our fall, if you will. But yeah, the recency bias is actually probably the biggest kicker or curveball for this whole thing, though, because it's not as an aggressive. The fundamentals are not as aggressive as what we saw with cocoa. Yeah. Structural difference is completely different. But you have so many people that are like, oh man, look at OJ and how OJ moved. Look at cocoa. Yeah. Now, like, let's look at coffee. Like, let's rip this thing to the upside. Be careful with it if you're going to, but there's a structural reason why we are seeing a move. And I don't see anything on the horizon near term right now that says to fade it until we start seeing better weather patterns and we get more transparency into the growers here as to how they're bringing things to market. Now, I will kind of go back and say that cocoa trade, though, and you're going to probably start seeing this from a lot of countries. There were a lot of producers that were trying to hoard product. And we kind of talked about it. It's like super rare to like default on actually delivering physical product. Like, to do that, you kind of like are really risking your reputation. We had a reversal of that for cocoa, right? Are we going to see the same thing for coffee? And that's the biggest, I don't know, but I have a firm suspicion that the coffee market's going to be a little bit more stringent as far as the hoarding that's out there and really taking it to those that are trying to keep product out of the market, even though they have product.
No, I agree. I think there's the first thing when I wrote about it was it has a similar setup to something when the cocoa trade started. However, it's nowhere near what happened in cocoa. And I still think, but once again, it's like, what do market participants think is going to be really the issue? Are they going to do something similar? That's kind of where it's really always very dicey. And the reason why I run so many systems is like that's the part of it that you can't really predict. You can understand the fundamentals, even the technicals to a degree, but you can't really understand how market participants will react. I still, once again, I'm with Kevin. Just experience says that I don't think this is going to run like cocoa, but we're traders. We don't need everything to run 300% to make it a good trade.
Especially in the commodity complex. Let me just look up something really quickly though.
Mm-hmm.
Because I was under the impression, and I have to, and mind you guys, I was out for a little bit, so I'm still getting caught up on a lot of these markets. Give me 1 second though.
Mm-hmm. No, you're good. And just basically thinking about it when you're going through all these different commodities, what Kevin just said about like we don't really need it to go up 200% in the commodities market. And that doesn't mean like what you think it means. It means that we use leverage products like futures to trade these things. Something that might be 10%, a 10% move for somebody could be 20, 30% for some of us, So once again, we have these leverage products. And that's why I think that, so many people get so psyched on options all the time. And it's like, man, there's a much cleaner product that will give you the same amount of leverage. And it doesn't have time decay. You're not going to lose everything because it just went to zero one night. You don't have gap risk. You can set stops very easily. You can even set them through the night. So, I mean, these are reasons to trade the futures market.
Yeah. Okay. So here's what I was looking at. I had to look this up. Okay. So because in the past it wasn't the Arabica beans that were the issue, right? That was actually in pretty decent supply. It seems like that's going to be that is the issue right now, and it looks like there are smaller bean sizes that are taking place now. They have been experiencing a drought in these areas that they're growing this particular crop, and it does appear that Honduras is actually suffering very significantly. They're down around 24% when it comes to their coffee production compared to this time last year, which is also pushing those prices higher. But Colombian production actually has been pretty healthy. So this is where the dynamics kind of like shift. Where it kind of depends on it depends on a lot, right? But do we have enough in storage to be able to supply the market? I don't have that answer for you guys, hands down. I don't. As far as the when you're looking at the Arabica strain, I don't know what the inventory levels are there, but yeah. That's a weather play, right? You play the weather plays until you don't, but just know that once it does crack, it cracks fairly hard here. And yeah, that's kind of where we're at, man. I do have to jump, dude. I had another thing I had to time on this show, but I'll show it next week.
I mean, or if you get some time on Friday, jump in the next show, or we could just have a pop up whenever, man. Whatever. What were you thinking of before you go?
That natty gas trade.
Yeah. Okay, so let's do that.
So we had a little bit of a pullback, but I want maybe next week we can kind of discuss what's happening out in the South, right? Especially in Texas. Let's talk about Texas next week. We're gonna get our oil hats on and we'll talk about Texas because there's a unique situation that's actually taking place out there, and it could actually have an impact when it comes to the commodity space as a whole in the summer. And I think that's something that we can leave as a teaser.
Nice. No, I mean, it's once again, it's a very significant thing that has a lot to do with the energy space, and obviously my cat behind my head. So, all right, guys, you guys have a good one. Kevin and I will be back with a little bit more on energy. I think we had a really good talk today, really concise. Thanks for coming on, Kevin. I know you got a bunch of things going on. Thanks for dropping in, man.
For sure, man. We'll connect. We'll try to do another session this week for sure.
Okay, sounds good.
All right. Peace.
Later.